Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello friends, I'm Vijay Bambwani and I hope my videos are helping you master the moves of the markets better and you're able to understand the intricacies of this market a little better after watching my videos. Today's video may not go down well with all of my viewers and that's okay. My job is to present facts here and many a times I tend to be a little ahead of the market and at the risk of appearing wrong initially, I do make some projections. I'm talking about interest rates here, a burning topic. You've already seen what happened when the RBI raised interest rates by 40 basis points and it was followed up by the US Federal Reserve raising rates by a full 50 basis points. I belong to the school of thought which believes that interest rates need to go up further. Not only do they need to go up further, but they will go up further. Whether you like it or not is not the question here. You see, what you have been hearing and seeing and being told all the time by whoever it is that's basically talking about interest rates, etc. in the public domain is a lopsided story. Let me explain. This is a 10 rupee coin. The side that's facing you is called the tails. This side now is the heads. Alright. Now every coin has two sides to it. Would you like a coin with only one side and the other side being completely sheared off? Not at all, because there are two aspects to the coin, heads and tails. So also the interest rate debate has two aspects and it has implications on your portfolio, be it in your debt funds, be it your equities, be it your commodities trading or even Forex. Now you see, for far too long, the guys who write out the checks, the HNIs and the ultra HNIs, HNIs would mean high net worth individuals, have been getting negative or zero yields on their fixed income investments. And those of you who've stuck with me long enough know that I am a dedicated investor who allocates his money in different asset classes. And I'm a big votary of sovereign debt. I've made videos about the RBI Retail Direct GSEC scheme access, investing in bonds, how you're getting 7.25%, 7.3% return of fully 100% government guaranteed avenues against 5 lakh rupees guaranteed in a bank fixed deposit at 5.5%. So you know that I'm tracking the interest rate markets and bond markets very, very keenly. As a matter of fact, so should you, especially if you're a bank nifty trader. Because the bond market is the financer or the money source for all other asset classes. And so far, the checks written by the high net worth and the ultra high net worth individuals in the debt market, which were fueling the other asset classes, were being deployed at zero interest rates. Why zero interest rates? Because here is inflation, here is interest rate. If both are matching, the real effective interest rate or the inflation adjusted interest rate was coming to zero. What could be the result of this happening for long enough? The guy who's writing out checks might just get a little put off and stop writing out checks. What happens then? The financial markets have a liquidity shock. Suddenly, money will dry up. So far, you were told by your school teachers and economics teachers in colleges, the experts in the public domain, that low interest rates stimulate demand. It enables your average Joe to go out there and buy things on EMIs which he could not have otherwise bought, and corporate profitability is going to go up. Give me a break. There are 4 factors of production and money or finance is only one of them. If you think that lower interest rates are the be all and end all to boost demand, you've got another thing coming to you in your investment portfolio, and it's not going to be pleasant. The reason why I'm saying that there are two aspects to the interest rate conundrum is because interest rates, when they fall, they favor the borrower, but they are unfavorable to the investor. Now, when an average investor is stopping writing out checks because he's getting subpar returns or negative returns after inflation adjustment, and there's a liquidity crisis, there is another alternative that the government can resort to, which the US already had. Start printing more money. But when you start printing more money, money loses its purchasing power and hyperinflation will result. So you'll either have a recession following, or you will have a deflation hitting the markets because the rich have stopped writing out checks. There are no prizes for guessing who moves the needles and gauges in the market. Does an average retail investor's checks move the market prices, or it is the big money that writes out massive checks that move the needles and gauges in the market? Now, if big money wants higher interest rates, they will come. So it's not a question of you and me having a choice about it. It's bound to happen. Now, the fallout. The fallout is going to be multifold. I have told you in my recent videos about NBFC stocks. You see, the one thing what happens to interest rates rising is that the cost of funds go up. And to NBFCs, money is both a raw material and the finished product. So the NBFC will borrow money from banks, the raw material price will go up, and since it has to keep its own profit margin, it will raise the price of the finished product, which means the loan that it will hand out to people for buying white goods. You know, you go to a supermarket and you buy a color television or a refrigerator or a washing machine, and you get EMI schemes from a financing company which has a desk in the supermarket itself. These are NBFCs. Now you'll realize that people who are purchasing goods on leverage, by leverage I mean EMIs, will face higher EMIs. Cost of funds are likely to go up. So NBFC stocks are likely to remain under pressure for a brief period of time. I've been asked, Vijay, why don't you talk about banks? Why don't banks come under pressure? Because, hey, when corporates or businesses open current accounts with banks and they keep millions of rupees per account in those current accounts, they get zero interest. So the bank is actually getting zero cost money from current accounts. From savings accounts, they are getting money at between 3 to 4% per annum. So this ratio of current account versus saving accounts is also called CASA. The banks that have a very favorable CASA ratio have lower cost of funds. So a bank will not get as hit as an NBFC will where cost of funding is concerned. Which other sectors will feel the heat of rising interest rates? Think of all the businesses that are dependent on EMI based purchases for reporting higher sales. I just gave you an example. How many people actually go out there and buy automobiles, whether they are passenger vehicles or PVs or commercial vehicles or CVs? How many people go out there and buy two-wheelers, washing machines, fridges, LED TVs with their own money on down payment? Very few. Most resort to EMIs. Now, all these companies, all these industries will see their stock prices taking a slight knocking in the near term. Just if you're like me, taking a screenshot of the trading terminal once the trading session is over, go back and take a look at the screenshot of the trading terminal on the day the RBI governor raised interest rates. Tell yourself and check for yourself as to which sectors, which stocks fell the most when the RBI raised interest rates by 40 basis points. these are the stocks, these are the sectors which in the near term, because they are dependent on EMI based sales, are likely to underperform in the near term. So, is there any recourse? Yes, there is a recourse. And although, like I said at the beginning of this video, some of you may not like what I'm saying because I'm a votary for higher interest rates. Not surprising. I have sovereign investments and I keep laddering those investments. So yes, I tend to gain from rising interest rates to that extent. And when I in my Diwali video told you that the prime pick from this Diwali to the next would be the GS 2035 sovereign guaranteed bond from the RBI Retail Direct Investment Scheme. Even though the stock market has fallen from October peaks of 18,600 of the Nifty, values of people's equity portfolios may be down. I've already received interest on my sovereign investments. So to that extent, I've saved myself erosion that equity would have given, and at the same time, I've taken positive returns. So do diversify your money. There are beautiful investment opportunities available, commission-free trading on the RBI's own website, where you're dealing directly with banks without any middlemen. So the GS 2035 series bonds come to my mind. That's the prime pick. There are obviously going to be others, and as and when I spot more and more bonds, especially some very robust state government bonds which are also under the sovereign guarantee category, there are times off and on when you even get double-digit return per annum in many of these bonds. So you should keep some amount of money there. Diversify and keep some amount of money in gold. Even though gold and silver have fallen, like I mentioned in my yesterday's video, metal prices are coming down sharply. Mark-to-market losses in those metals are making people sell all their commodities. So an iron ore, a copper contract, a zinc and a lead contract is falling, and so is gold, because it's the same trader who's gone long in copper and in silver and gold. When he's losing money in copper, he's panicking and selling gold and silver as well. That's fine. It's perfectly routine. After people collect their wits, after people have calmer nerves, then they'll come back and buy gold and silver all over again. So this is my game plan. I'm going to avoid any and every industry that is dependent on EMIs for its sale. You might feel that rising interest rates are a problem, but for every problem, mother market gives you more than one solution. On this optimistic note, I bid goodbye to you, not before reminding you to click like on this video if you liked what you saw. Subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. Good, bad or ugly, I love hearing from you in the comments section. Also, help me reach out to fellow like-minded smart investors like yourselves who believe in logic and rationale in their trading and investments, and refer my videos to your family and friends. Thank you for your patience in watching my video. Till we meet again in my next. This is Vijay Bambwani signing off for now. Take care. Bye-bye.
Our new research uncovers some shocking truths behind today's hottest investment opportunity, electric vehicles. Don't invest your money in EV stocks before seeing our research. Click here to sign up for our special event to know it all for free.